Hey everyone, welcome back to Corporate Decoder. Today, Fidelity Capital Trust just filed their semi-annual shareholder report, and I am seeing some interesting moves in their portfolio that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's investment strategy seems to be heavily weighted towards technology and industrials, with a significant portion still in the United States. This is a look at the Fidelity Capital Appreciation Fund as of the 30th of April 2026. A major highlight is that their common stock holdings make up almost 99% of the fund's net assets. That tells us they are really putting money into individual company stocks looking for growth. Looking at the common stocks themselves, the top sectors are information technology with over 31% of assets, then industrials at 12.6% and communication services at 11.5%. This shows a strong leaning towards companies that drive innovation and infrastructure. Within information technology, the biggest chunk is in semiconductors and semiconductor equipment at over 12%. That means they are betting big on the companies that make the brains of our computers and phones. The top holdings in this fund are pretty telling. NVIDIA Corp is leading the pack at 8.4%, followed by Amazon.com Incorporated at 6.6% and Alphabet Incorporated Class A at 4.9%. These are all huge companies in areas like AI, cloud computing, and e-commerce. NVIDIA has been a standout performer, so it makes sense it is a major holding for a capital appreciation fund. When we look at the financials, the total investment in securities is over $7.8 billion with a primary focus on the United States at nearly 88% of the fund's net assets. This is typical for a US-based fund, but it is worth noting they do have some international exposure to countries like Canada and Taiwan, which adds some diversification. The statement of operations for the 6 months ending the 30th of April 2026 shows a net investment income of $14 million. But the big story here is the net realized gain of $368 million and a change in net unrealized appreciation of nearly $400 million. This indicates that the fund's value really went up because the stocks it owns increased in price, rather than just from the dividends or interest it collected, which is expected for a capital appreciation fund. The net assets for the Fidelity Capital Appreciation Fund have grown considerably, reaching over $7.6 billion. This is a good sign showing growth in the fund's value. The financial highlights also show a strong total return for the 6-month period of over 11%. This suggests the fund's investment strategy is working well in the current market. Now let's dive into the Fidelity Capital Appreciation Fund Class K shares. The financials are very similar to the main fund, as expected since they invest in the same underlying assets. The net asset value and total return figures are also quite comparable. The reported expenses before reductions for this class are about 0.66%. This is a reasonable expense ratio for an actively managed fund. The fund has a significant portfolio turnover rate of 76%, which means they are actively buying and selling stocks, looking to capitalize on market movements. The notes to financial statements give us some important deets. The fund invests in what are called Fidelity Central Funds, which are basically other Fidelity funds available to Fidelity managed accounts. They also talk about Level 3 securities investments valued using unobservable inputs. This is important because it means some of their holdings can be harder to value and might carry more risk if market conditions change unpredictably. The fund has significant valuation input ranges for some of its convertible preferred stocks and common stocks, like enterprise value to revenue or EBITDA multiples. This is a common practice for valuing private or less liquid investments, but it does mean their value has a bit more estimation involved. The company's overall direction seems to be focused on growth stocks, particularly in technology and communication services. The substantial gains in realized and unrealized appreciation point to successful stock picking, or at least a favorable market for their chosen sectors. The top holdings are all major players in their respective fields. The main risk I'm watching is the heavy concentration in the US market and the significant exposure to volatile sectors like technology. While that is where the growth is, it can also mean bigger swings in value. My biggest concern is the dependence on a few very large companies like NVIDIA and Amazon to drive returns. A downturn in those specific names could impact the fund more significantly. What I'm actually looking for is continued diversification within these growth sectors to mitigate that risk. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, and subscribe for more, and check Discord in description.